Hello, everyone. Greyson Geiler with Secure Estate Solutions here. Going to do a market update. Going to talk about the wild week we had last week. The stock market went way down and ended the week pretty much unchanged. Okay, so when I'm talking about we had a wild week last week, we're talking about the biggest volatility the markets have seen since the COVID crisis back in March of 2020. The NASDAQ was down more than 1,000 points during the day Monday. They were calling it Black Monday, referencing previous market sell-offs. A lot of people were coming out saying that the Federal Reserve should lower rates immediately as an emergency. Jeremy Siegel, pretty famous market commentator, a guy from Wharton, he was on CNBC saying that the Federal Reserve should immediately lower 75 basis points, and they should lower at least another 75 basis points coming up at their September meeting. So it was real panic in the marketplace. I don't think I have to tell you how bad of an idea it would be for the Federal Reserve to come running out and lowering rates just because the market had a rough morning. But that's what people were saying. Now, by the end of the week, things had completely calmed down. The volatility was way lower, and markets had bounced back and pretty much ended, if we're talking about the major stock indexes, pretty much ended the week where it started. So pretty crazy week. Well, why did it happen? What was the catalyst that made everything sell off like that? And it was really the carry trade. So we're talking about the Japanese yen carry trade. So here's a chart of the Japanese yen. Now it's been coming down for years, but the important part is the Bank of Japan has had zero interest rates for decades now. So traders will borrow money in Japanese yen terms. They don't have to pay any interest on it. The interest rate is essentially zero. And then they buy assets around the globe. As an example, they might come over and buy US Treasuries right now for 5%. Well, that's a free 5%. Pretty cool, right? But wait, there's more. The Japanese yen, having been, this chart right here is just going back to November of last year. But for years, the yen has been going down in US dollar terms. So the people that have put these carry trades on, and we're talking about hundreds of billions of dollars have put this carry trade on, they are making money on the differential between essentially zero borrowing costs and owning maybe a US Treasury for 5%. They bought a ton of tech stocks, which obviously have been going up a lot over the last couple of years. So it's been a pretty amazing trade, but they're also, because they owe yen, the value of the yen is going down versus the dollar, they make more money essentially being short the yen. Nice money-making machine, right? Just printing money. The problem comes in, and you're looking at the chart of it right here, when the Japanese yen goes up versus the US dollar. And that's what happened last week. The catalyst was probably the Bank of Japan coming out and saying they were going to raise interest rates, and the carry trade got unwound. Hundreds of billions last week got unwound in that carry trade. So again, the market's really calmed down by the end of the week. So does that mean it's over? It looks like the vast majority of the carry trade has been pulled off. As a matter of fact, though, maybe towards the end of the week, people were putting the carry trade back on because the Japanese yen, after such a rocket launch that you're looking at right here by the end of the week, had given a lot of that rally back. So maybe some people are putting the carry trade back on. So we just have to, we're kind of back to ground zero. Well, what now? What's going on in the economy? Are we confident that the stock market can hold together, bond markets can hold together, commodities, everything's going to be okay now that we just shook the tree a little bit? Maybe. We're a little bit nervous about some of the economic numbers coming out. Inflation has calmed down significantly, almost back down towards the Fed's 2% target, but unemployment is higher. Looks like the American consumer is starting to run out of steam a little bit. The credit numbers are up a lot higher because the average credit card interest rate is something like 24%, something crazy, and people are holding a lot of credit card debt now. So maybe this consumer's slowing down quite a bit. Maybe they're not. but we'll see coming up. The Federal Reserve is going to lower rates coming up at their September meeting, and the marketplace is predicting about a 50-50 chance of a 25 basis point cut in interest rates, 50% chance of a 50 basis point cut in interest rates. So time's going to tell on that. But again, the markets have held together very well. Hopefully, it will continue to do so. We're, in the long term, we're very nervous about the kind of debt numbers that our government is running. 7% budget deficit in a year where unemployment's down around 4% and the stock market's near all-time highs. That's reckless. That's absolutely insane. But that's not going to hurt the stock market in the near term. As a matter of fact, that extra government spending is probably helping it is helping the stock market hold together in the near term. Obviously not a long-term sustainable solution to some of the challenges we have, but we can deal with that down the road. In the meantime, if you like the presentation, smash the like button, share it with your friends, subscribe to our channel. We'll see you next time. And in the meantime, don't sell your gold.